weeks ago was phenomenal when I had a look at the chat box. So it's very, very exciting to be with you. The last session we talked about financial planning 101, and in this session we will be covering two important topics, which is, one is tax planning and the second one is Sensex is at 52,000 levels, both very, very important and exciting topics to talk about. But before starting the discussion, Preeti, I'll request you to put in the chat box the attendance sheet. Always, this is an important attendance sheet for us. Request you to fill it in if you've not already filled in. It helps us in understanding your financial expectations, understanding the expectations out of this web, as well as creating more tailor-made content towards an organization. So we'll be circulating this attendance sheet a couple of times during the webinar. Ignore it if you've already filled it in, and it'll be for the benefit of the new joiners who are joining in a little bit later in the session. The flow of the session, we'll talk about tax planning at Sensex at 52,000 level for about 40 minutes, and the remaining 20 minutes we'll keep in for questions and answers. So I'll be starting the session now. So I'll just request anybody to confirm the screen is visible.
Yes, yeah, progress. Then you can see that.
All right. Thank you. So tax planning is going to be beneficial for those employees who have recently started their careers and are looking for tax planning options. It is also beneficial for those people who are already doing tax planning for themselves for a couple of years, but wish to know what all other options are available in the market. So I'll be covering three major sections of the Income Tax Act, which is Section 80C, the biggest chunk of your 1.5 lakh investments which go towards your tax planning. We started the discussion with that with Mohit. We will also be talking briefly upon Section 80D, which is health insurance, and Section 80CCD, which works on your national pension savings schemes. So while we've been interacting with Microsoft employees over the past 2 weeks during their individual financial planning sessions, we got to know that most of them were skewed towards public provident funds, term insurance policies, life insurance policies, some towards ULIPs and some towards Sukanya Samriddhi schemes. While these are interesting options to know about, let's explore all of the options which are available to us, and let's analyze them basis two parameters, that is the returns that they generate for you as well as the lock-in period, so that you can now take an educated call towards investing further in these tax saving instruments. So, coming to the first and foremost tax planning instrument, which is employee provident fund. Here you don't have to do anything. Your employer as well as you yourself jointly contribute towards your employment provident fund scheme, and this is a 12% joint contribution both by the employer and the employee, which goes towards your retirement planning. This is available to you either after you retire or after you resign from your organization and no longer prefer to work. The annualized interest rate which has been declared by the government is 8.5%. It's a very attractive rate of interest to go by. So it's important to note that those of you who are already investing into EPF up to the extent of 1.5 lakh rupees do not have to do anything additional in terms of tax planning under Section 80C. So please have a look at your salary slips. If you see that annually 1.5 lakhs is already being invested into EPF from your salary, you do not have to do anything in addition to this in the 80C tax planning section. You need to look at other sections for your tax planning. The next instrument that we would be coming to is the public provident fund. Now, most of us have been introduced to public provident fund by our parents. I'm sure there will be a lot of you who where the public provident fund accounts would have been opened by your parents when you were a minor and you would have been assigned the management of that account when you would have turned a major, and that is how you came to understand about public provident fund. That's how I came to understand about this. Now, the interesting thing to note is that they were initially giving more than 8% interest rates till just a few years back, but because of the fact that interest rates have come down drastically in the economy, they've now come down from about 6% to a 4%. That's a repo rate that I am talking about. This rate directly has an impact on all of the financial instruments rate. So along with your fixed deposits, your recurring deposits, your savings account, all the government introduced financial schemes also suffer a rate cut, and hence public provident fund is now giving a 7.1% interest rate, and it has a lock-in period of 15 years, which means that you need to invest for a minimum period of 15 years if you've started the account, and this can also be extended unlimited number of times by a block of 5 years each. We do not find this to be a very attractive option in the market because it's giving us a 7.1% interest rate, and the inflation itself is a 6.2% figure, which means that this instrument is only beating inflation by a nominal 1%. Not a very attractive rate of interest to go by, especially considering the fact that your money is now locked in for 15 years. Let's have a look at the other investment options which are there. I'll cover ELSs in the last. We also saw a lot of the employees holding term insurance policies. Now, the advantage or the intent of getting a term insurance policy should be financial protection and not necessarily tax planning. So you should look at a term policy if you do not have a financial protection for your family members. This term insurance policy is designed to substitute your income stream should anything happen to you, and a lump sum is then given to your family members in lieu of the premiums that you paid. So each and every year, whatever premium you are paying towards your term insurance policy will get counted under Section 80C. It is not designed to give any sort of a return, nor does it have any sort of a lock-in period. It continues till the time your policy is kept alive. One must always have a basic term insurance plan, not necessarily fancy ULIP plans or life insurance policies which are giving you a factor of interest rate as well, but one must consider a basic term insurance plan for the financial protection of the family members should anything happen to you. The other schemes that we have seen have been invested by the employees are unit-linked insurance plans. We had a small discussion on unit-linked insurance plans during the last session. We talked about that the interest rates, the returns which are generated by these unit-linked investment plans are largely linked to the market performance. In the current performance, your unit plans, if you've taken it, might be doing very well, but one must be aware about the charges that a ULIP policy is subject to before investing. Charges are often not revealed to the investor before actually getting in. They come to know once the booklet is then delivered to their house. So there are 4 kinds of charges which are predominantly built inside a ULIP plan, which is a fund management charge, a policy administration charge, a premium allocation charge, and a mortality charge. The higher your age, the higher will be the mortality charge, and hence the higher charge you pay towards the inbuilt premium when your returns come back. So the returns will be linked to the market conditions. However, the returns will be net of these charges. These charges will start from anywhere between 2.5% and may go upwards of 5% depending upon your age. So if the returns, once the returns do get delivered to you, they will be subtracted by between a figure of 2.5% to a 5% before the final returns are then generated by the instrument. The minimum lock-in period that you have inside a unit-linked insurance investment plan is 5 years or more, which makes it a slightly unattractive financial instrument to invest into. There are life insurance policies which give off 4%, which give you a combination of an investment as well as an insurance factor. These are designed to generate a return on the premiums that you pay, and they also give your family financial protection in the form of a sum assured should anything happen to you. But because they're a combination of investment and insurance, they do not give the best of returns. So the typical returns which are there in any A life insurance policy are between 4% to 6%. I have not come across a single life insurance plan which gives you more than 6%. So these plans are not beating inflation, which is why they do not make sense for an investment plan. Moving on to the next scheme that a lot of you are also investing in is the Sukanya Samriddhi scheme. Sukanya Samriddhi scheme was introduced for parents with a girl child, and it was part of the Beti Badhao, Beti Bachao campaign. It is generating a 7.6% interest rate. This interest rate is declared quarterly by the government, and the minimum investment tenure that you have is 14 years. The maturity of the scheme happens at the age of 21 years or at the marriage of the girl child. One can look at the option in terms of diversification of their investments. However, again, the interest rate that we are seeing at the moment is 7.6%, which is also a downward trend. We've seen interest rates in this scheme at a higher than 8% just a couple of years back. But again, since the interest rates are on a falling scenario, these do not look as very attractive options in terms of the interest rates that they generate for you. There are much better options available in the environment for tax saving. So there are multiple national pension schemes. National pension scheme is something that I'll be covering in one of my later slides, so we'll leave this for that. Senior citizen scheme is something that can be looked at for people who are above the age of 60. So if any of you have parents who are above the age of 60 and wish to do their tax planning, that can easily be done through a senior citizen savings scheme at a 7.4% quarterly declared rate. Please note that they also have a minimum lock-in period for 5 years. One thing that I have not discussed that I wanted to discuss at the end of this slide was the equity linked savings scheme option. These have recently emerged and as the most popular option for investment schemes under Section 80C under tax planning. So ELSS refers to equity linked savings schemes. These are mutual funds which invest into the equity market, but with the purpose. So you can see that out of all of the options, the ELSS option has a minimum lock-in period for 3 years as compared to others which are at 5 years, 15 years, etc. One must also note that the returns which are generated by ELSS instruments are also dependent upon the performance of the stock market. If there is volatility in the stock market, if there is a market crash, the ELSS may give a negative return. But please note that they are having a lock-in period of 3 years. Now, equity by nature is volatile in the short term. You may face a lot of volatility. You may see a lot of negative returns which are there in 1 year, 2 years, 3 years as well. But post 5 years of a horizon, the volatility in the equity market tends to get ironed out and is no longer there. So take out any good performing equity linked savings scheme. I've analyzed the entire category average and we've seen that the minimum return that any ELSS has returned in the past 3 years is 12%. That's beating all of these other instruments by a factor of at least 4%, which makes ELS not only the most popular but also the most financially advantageous options to go for in terms of your tax planning. Another important section under ATC is the principal of the home loan. So if any of you have opted for a home loan and are paying a combination of principal plus interest, the government has given us a tax deduction of up to 1.5 lakh rupees in terms of the principal being repaid to the banker. So 1.5 lakh rupees, if it's a principal which is being paid to the bank, can be utilized under Section 80C. If that is already covered, you do not need to consider any additional investment for tax planning. So I talked about equity linked savings scheme in the previous section. 3 important factors to note over here. You can invest a maximum of 1.5 lakh rupees under Section 80C. They are investing predominantly into equity and hence will have a higher return and risk spectrum associated with them, and they have the shortest lock-in period of 3 years as compared to any other tax saving option. We have a short YouTube video which has been designed by mutual funds Sahi Hai for you. This explains how an ELSS works. I'll again request somebody to confirm to me if they can see and hear this video.
Yes.
पूछेगा नहीं मैं क्यों इतना खुश हूँ क्योंकि तू पागल हो गया है करने का वक्त आ गया है
देखो पूरा पागल हो गया 4 लोग रो रहे हैं तो वो सेलिब्रेट कर रहा है
हाय लो केक आ गया थैंक यू बेबी आई वाज जस्ट एक्सप्लेनिंग व्हाई आई एम सो हैप्पी लेट मी एक्सप्लेन सेलिब्रेशन की वजह है ELSS
ये ELSS क्या चीज है
ELSS वो चीज है जो तेरी टोटल टैक्सेबल इनकम से अप टू 1.5 लाख का डिडक्शन अलाउ करता है अंडर सेक्शन 80C ऑफ द इनकम टैक्स एक्ट एंड द बेस्ट पार्ट इज दैट अनलाइक एनी अदर ट्रेडिशनल टैक्स सेविंग ऑप्शन इसका लॉक इन पीरियड है 3 साल क्योंकि पैसे इन्वेस्ट होते हैं इसीलिए ग्रोथ के बहुत ब्राइट चांसेस होते हैं
यानी सेविंग भी
और वेल्थ क्रिएशन भी
टैक्स सीजन का मतलब है टाइम टू मेक मोर मनी थ्रू ELSS
तो टैक्स सीजन में खुशियां मनाइए क्योंकि ELSS में इन्वेस्ट करने से आप हर साल 1.5 लाख तक का इनकम रिडक्शन एंजॉय कर सकते हैं हैप्पी रिटर्न्स ऑफ द टैक्स डे म्यूचुअल फंड
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
All right. Now moving on to section 80D, I would again request somebody to confirm if the same is visible. Is the next slide visible under section 80D?
Yes, ma'am. Yes, visible.
Thank you. So section 80D talks about health insurance. Now I know very well that all of you have been covered by your employer with a very comprehensive corporate insurance plan, but it is important to understand section 80D from the perspective of tax planning, because you cannot utilize your group health insurance plan which has been given to you by Microsoft India for the purpose of saving upon your taxes. But if you decide to procure a separate health policy, a personal health policy in your name or in your parents' name, there is definitely scope to save upon the taxes. So there are two ways in which these taxes can be saved. One, it can be in the form of the premium which you are paying for health insurance for yourself, as well as so it can be in the form of health checkups or any healthcare related expense that you are paying for yourself, spouse, children, or your parents. Any sort of a preventive health checkup which is in the form of the health checkups, the health exams which are being conducted also gives you a deduction of up to 5,000, but please note that this 5,000 is only up to the maximum capping of 25,000 or 50,000. We can have a look at the maximum capping which has been defined for yourself as well as your parents. So if you are below the age of 60, you can enjoy a maximum deduction of 25,000 rupees under health insurance. Over the age of 60 years, you can this capping then increases to a 50,000 rupees. For parents, again, the capping is very similar. Below 60 years, there is a capping of 25,000. There's a maximum eligible deduction for 25,000. If parents are above 60 years of age, the capping then increases to 50,000. That means that the maximum deduction that an employee can avail if he takes a health insurance policy for himself as well as his parents who are below 60 years is 50,000 rupees. And if the parents and the employees are also above 60 years of age, the capping increases, the deduction increases to 1 lakh rupees. The preventive health care is up to the extent of 5,000, but it is well within the capping of this 50,000 or 1 lakh rupees. That means that your total taxable income can get reduced by either 50,000 or 1 lakh rupees should you take a health insurance plan in your own name as well as in your parents' name. Coming to the last section under tax planning, which is section 80CCD. Section 80CCD refers to the National Pension Savings Scheme. National Pension Scheme has been designed by the government to provide you as a secondary source of income in your retirement years. These carry a lock-in. The National Pension Scheme carries a lock-in up to the age of your retirement, and you can invest in either Tier 1 as well as Tier 2 accounts. There are two sorts of accounts. I'll touch base upon Tier 1 account. Tier 2 operates just like a savings account. So Tier 1 account has a lock-in period until the subscriber reaches the age of 60 years. Please note that you will not be able to withdraw the money that you have invested out of your NPS savings schemes account, except for any exigency that could be in the form of a marriage of a child or education or early retirement. The contributions that you make towards your Tier 1 NPS account are tax deductible, and they qualify for deductions under Section 80CCD1 and 80CCD1B. Under 80CCD1, you can invest up to the maximum 1.5 lakh rupees. Please note that this is same, or this is covered within the Section 80C that we discussed in the first slide. This is not over and above that. That means that you can invest up to a sum of 1.5 lakh rupees either in those tax saving instruments that we discussed or in NPS, but not both of them and claim a double deduction. So the maximum you can invest is only up to 1.5 lakh rupees is under Section 80CCD1, and under 80CCD1, you can invest an additional amount of 50K in additional tax deduction. This means that the total amount that you can invest in an NPS scheme is 2 lakh rupees, and you can claim deduction on the full amount. One topic that has become a favorite amongst various financial circles is that Sensex is 52,000 level. What lies next? There are two prominent groups which have been formed today. One which says, oh, Sensex has reached 52,000 level. It's a good time to get in. Why don't I also invest and make money out of this bull run? And there is a second more rate of investors which says that, oh, Sensex is at 52,000. It's at an all-time high. Investing in.
Shalim, I'm sorry to interrupt. We lost you in between. Can you repeat the section from Sensex? All-time high.
All right. So Sensex is at the 52,000 level. What lies next? This is a very popular discussion which is happening in financial circles. There are two prominent set of investors that we have. One says that, oh my God, Sensex is reached at a 52,000 level. It's a good level. Let me also invest in it and make the most out of the bull run. And there's another more wary set of investor which says that, oh, Sensex is at a 52,000 level. Should I be investing in it? It's an all-time high. What is going to happen afterwards? So in order to talk more about Sensex is at 52,000 level, we also have Abhishek Kumar with us. Abhishek is the managing partner at Ingenetus. He wanted to speak to all of you about Sensex over here. So over to Abhishek. Mohit, I'll request you to give the presentation of the screen to Abhishek.
Hi, thank you, Shalini. Just a second. Yeah, thank you, Shalini, and thank you everyone for joining in today. So very interesting topic that we have now. What to do at Sensex at 52,000, right? What next? What lies next? Can everybody see my screen?
Not yet, sir.
All right, just a second. Is the screen visible now?
Yes, sir. Screen is
Perfect. So a very interesting question, what to do when the markets are at 52,000. We'll try to figure out in the course of the next 10 slides, and I'm sure after these 10 slides, a lot of things will be clear to everyone. But have you ever noticed that whenever we try to enter the market, there is never a perfect time? I mean, all of you or some of you would have noticed that last year, the Sensex was at about 30,000. It fell by about 40%. Probably, I don't know how many of us entered at that time. Right now, the Sensex is at 52,000. So, in both highs and lows, in lows, we have a panic selling, and in highs, we feel that the market is too high and it will come down. So, there is never a perfect time for us to enter into a market. Have you ever seen a time where we are confident enough that, right, this is a very good time to enter in the market? So markets at all-time high. So is it really at all-time high or is it a till-date high? By all-time high, we mean that this will never go beyond this. And till-date high is we have seen the highest level of the market till date. So according to us, it is not all-time high, it is till-date high, right? Coming to the next slide, can you predict the market? So a lot of us, we try to, predict the market. We try to predict at 52,000. We try to predict that, Abhi, this will come down a little. At 30,000, we try to predict that it will come down further. So can we actually predict the market? So I have, two articles from Business Line. I hope you can see it. Otherwise, I can zoom it for you. So these are two articles. One article is of April 16 last year, and the other article is of November 12 last year. Right? So Goldman Sachs predicted in April last year that the Nifty would be about 9,600 by June 2021. This was a prediction. Goldman Sachs, all of us know, is a very good company, very big company based out of the US. So they predicted the Nifty to be at 9,600 in June 2021. And we know where the Nifty is right now, right? But during the course of the year, they realized that, their prediction is going wrong. What they said is actually wrong because Nifty has gained a lot of momentum. So in November, they came up with another prediction that, Nifty 50, 2021 year-end target is about 14,100. So if we look at it, both the predictions for Goldman Sachs were wrong. So if a company like Goldman Sachs can go wrong on predictions, can us predict the market correctly? I feel that it's very difficult to predict the market in a shorter run, right? The markets are very volatile and you cannot predict the market. Just to give you an example, in March 2020, what happened last year? In February, nobody predicted that. And after what happened in March 2020, when the markets crashed by 40%, and not just in India because of the global pandemic throughout the world, nobody predicted the market to go back to the all-time high and make another high in the same year, right? So when you cannot predict the market in a short term, what else? How can you decipher that at 52,000 whether it's the right time to enter or not? So we cannot predict the market, but we can certainly estimate with numbers where the market is headed, right? So we'll try to do that in the coming slides. Let's look at how the markets have performed in a 10-year horizon in the past, starting from 1990. So this is the journey of the Sensex. It started off at 3,700 in 1990. In 2000, it was 5,000, and then subsequently 17,500 and 47,751. And currently, it's at 52,000 levels. So what will happen in 2030? Going by the chart, we certainly can also see that the markets will certainly not be at the level where it is right now. It will be at a higher level. But how to predict, or not to predict, but how to estimate that level? So, just a second. Yeah. The screen is visible to everybody?
Yes, sir. Screen is visible.
Perfect. So, just to make you understand how the stock markets behave, and this is a universal truth, right? I'm not talking about specifically of India, but any stock market around the world. A stock market of any country in the world is a follower of its economy. So if a country's economy is doing well, the stock markets are bound to do well. If the country's economy is not doing that great, the stock markets are bound to not perform, right? And just to make this point a little more elaborate for you, uh, if you look at the image, right? So what do we see in the image? We see a horse and we see a car, right? A jeep. Now let's imagine that this horse and this car is attached with an elastic string. Please, I'm emphasizing on the fact that it's elastic string. So a car, let's treat the car as the economy, and let's treat the horse as a stock market. So a car will have multiple horsepowers and is connected to one horse. What that means is the economy is the driving force for any stock market in the world, right? So if this car goes forward, sooner or later the horse has to follow. It might not follow immediately because it's an elastic string, but it has to follow. And if the car moves backwards or doesn't move, it will stay where it is or move backwards. So that's how the stock markets throughout the world work. How your economy of a country is working, how your GDPs are growing, are the factors of the stock markets to go up or down. So very interesting indicator, and there was a very recent article in the Economic Times also for this. This is called a Warren Buffett indicator because it was, Warren Buffett is a follower of this indicator and he follows this indicator like a principle. So this is called a market cap to GDP ratio. Now, GDP we all understand. GDP is the total income of the country, right? Which is India is placed at about $2 trillion at the moment, right? What is market cap? Market cap is if you multiply the current level of Sensex, which is 52,000 something, into the number of stocks, we get the total market cap of the stock market, right? Now, this market cap to GDP, if this indicator is at 100%, that means that the stock markets are behaving in line with the economy. So economy is doing well, so the stock markets are also doing well. If this indicator is below 100%, this means that the stock markets are underperforming the economy. That means the economy or the GDP is growing at a faster rate and the stock markets are not delivering that much of return. And if it's above 100%, that means the stock markets have overpowered the economy. The economy is moving slowly, but the stock markets are going up at a faster pace. So let's look at two incidents from the past. One is the financial crisis of 2008, and one is the pandemic crisis of 2020, right? Let's have a look where this indicator was and how it came to the level where it should have been. So for example, let's see January 2008. In January 2008, the Sensex was at 21,000. The GDP of the country was about 50 lakh crore at that time. The market cap was about 75 lakh crore. So what this means is the market cap to GDP ratio was at 148%. This means the market was overperforming the economy. And as I told you in the previous slide, this one, that whenever somebody overpowers the car or the horse overpowers, it has to come in line with each other. So what happened in 2008, October 2008, when the financial crisis happened, the Sensex came down from 21,000 to 8,000, and it came at a discount to the GDP. So GDP was still 50 lakh crores, but the market cap came down to about 28 lakh crores, which was at 55%. So what this means is, whenever the stock markets try to go up above the GDP or the economy of the country, there is bound to be some correction or the other in the near future. In January 2020, again, the markets were still the market cap was still lesser than the GDP of the country or the economy of the country. It was at about 80%. In March 2020, it became at 51 when the correction happened last year in the pandemic. And then right now, I've the slide till March 2021 when the Sensex was at about 50,792. It was at 100%. So markets were in par with the GDP or the economy of the country at that level. Now, there was a vision of the country to reach $5 trillion by 2024. The average growth rate from FY14 till FY19 that India achieved was about 8%. And to reach to 5 trillion, it required a growth rate of about 11.5%. Now, this 5 trillion dream of India to become a $5 trillion economy has got a setback because of the pandemic of 2020 and 2021. So let's assume that this doesn't happen by 2024. Let's assume this happens by 2026 or 2027, right? We are considering the fact that India, from a $2 trillion economy, will become a $5 trillion economy by, let's say, 2026 or 2027. And that is the basis of our estimate. So if we can, this is a rough calculation which you see on the screen. The GDP we have considered as $5 trillion. That in INR is about 400 lakh crore rupees. Market cap to GDP, the current market cap to GDP at 52,000 Sensex is about 101%. We are trying to predict from this formula that if the market cap to GDP ratio is at 100%, considering the GDP goes to 4 lakh crores or $5 trillion, where the market will be, right? So I have two factors which is listed below, 100% and 120%. 100% means that the market performs in line with the GDP or the economy of the country, and 120% means that the market overpowers or over-delivers than the economy of the country. Any guesses what this number can be for the Sensex for now? You can type in your chat boxes any number which you feel that, at a $5 trillion of Indian economy, where the Sensex should be at.
So we have a response from Ms. Saur Singh, 75,000 pointers. We have a response from Ashwini Jain, 60,000. From Aditya Mangal, it's somewhere around 1,05,000. And there is another response from Mr. Rishi Kapoor, 1 lakh.
Great. So we're pretty close in all the estimates. And see, we are not trying to predict the market over here. We are just trying to estimate where it will be, given the fact that the GDP comes to about $5 trillion, right? Whichever year that is, we are considering 2026 or 2027 for that matter. So let's look at the next slide. This is where we see the Sensex if we reach a $5 trillion economy. So there are three scenarios. One scenario is 80%, which means the markets underperform the pace of the GDP or the economy growth. 100% is in line, and 120% the markets outperform the growth of the economy, right? So Sensex at 80% reaches at 86,208. If the Sensex perform in line with the economy, it's bound to reach about 107,760. And if it overpowers the economy, it goes to 129,312. And subsequently, I've also taken out the numbers for the Nifty. Now, you can play around with this. which I have done because this was a calculator which was made. Let's assume India becomes a $7 trillion economy, which in GDP, in Indian numbers is about 560 lakh crores, right? Then the current Nifty, which is at about 16,000, 15,000 levels, goes to 52,000 levels. And the markets from 1,20,000 goes to 1 lakh, it stays between 1,20,000 to about 1,80,000. Now, these are estimates, right? When this will happen depends on how fast the economy grows, how does India do. But what we're trying to say over here is that, you know, in our investment journey, we always try to find the good time in the market to enter into the market at a good time. At 30,000 last year, I remember speaking to a lot of people. They were waiting for further corrections and then enter into the market. At 52,000, the people are still waiting for some corrections and enter into the market. Now, let's assume the markets correct from 52,000 to about 48,000 or lesser than that. In a long term, in a 10-year period, that entry point will not make much of a difference to your overall returns, right? And if you look at the Sensex, if you see the Sensex crossing 86,000 to about 1,20,000 in the previous slide, $5 trillion, then in a long term, 52,000 looks to be a very good entry point, right? But because we have not seen anything above 52,000 at the moment, we tend to rethink ourselves. So that's, I think, about it from my side. I'll pass on the control to Shalini to continue the presentation and take it to the close-up. Thank you, everyone.
Thank you, Abhishek. That certainly is an impressive figure, isn't it? 1 lakh by 2026 itself. Let me finally take you towards the conclusion of this presentation, and then we can start with the question and answer session. Yeah. Again, could somebody confirm if my screen is visible? I have a screen, the challenge of a painting in front of me. Is this visible to all of you?
Yes, ma'am.
Thank you, Preeti. So, I'm presenting a story to you. The story involves a king who was blind from one eye and he was also disabled with one leg. He was once having a look at his ancestors, his past generations, who were presented beautifully in multiple paintings and portrayals. He wanted a similar portrayal of himself. And he invited multiple painters from all over the country to portray him in a similar fashion. However, he had one condition. The condition was that the painting being captured should not portray his disability of his eye and his leg. All of the painters started leaving, for they could not think of a way in which they could portray the king without his disabilities. There was one single painter who was left at the end of the line, who stood intact and said, I am going to paint the king and I'm going to paint him without any disabilities. Can any of you fathom a guess how he managed to do so? What was his thought process behind painting the king? Any guesses? How do you think the painter would have painted the king without any disabilities, without showing the disability of his eye as well as his leg?
Ma'am, we have a response from Mr. Sri Vidya that he might paint that with the side view.
Okay, we're coming close. Any other answers? Any other guys? You can take a random guess. How do you think the painter would be portraying the king without showing his disabilities? Do we have any other answers, Preeti?
No, ma'am.
Okay. So moving on to the answer, this is how the painter had presented the king. He had presented the king while practicing his favorite sport of archery on a horseback, where one leg was behind the horse and hence was not visible, and one eye was shut while taking an aim with the arrow, and hence it was also not visible. It was visible while being shut, which completely masked both of the disabilities that the king had. So this is an allegory to the markets and our view and perception of the market. So look at the first graph over here. This shows the performance of the markets between 2015 to 2021. You can see various geopolitical events like China market crash, demonetization, GST reforms, Brexit announcement, ILFS scam, PNB scam, and most recently the COVID-19 pandemic. You can see that each and every factor has hit the market badly and it has dropped drastically downwards. So when people look at this sort of a view, they see a very microscopic view where the markets are extremely volatile in the short run. Now, take your concentration to the second graph over here. This graph is highly zoomed out and it talks about the performance of the same market represented in the first picture, but from a 1979 to a 2021 level. So it shows the brilliant journey of the markets from 1979, where the Sensex was at 100 points, to its performance of 50,000 plus levels in 2021 itself. So it is entirely up to you as to how you wish to picture the market. Do you wish to picture it in a microscopic manner and be scared of the volatility that it presents in the short run? Or do you wish to be an investor who is largely not bothered by geopolitical initially decided asset allocation strategy without wavering from it and continues to invest in a disciplined and consistent manner? When people do that, when they invest in a consistent and disciplined manner and stick to their asset allocation strategy, we have seen in the past that people are rewarded. Now, history always repeats itself. It is going to have these geopolitical crashes that it has in the past, and it is also going to have its bull run that it has delivered in the past. It will continue to happen in the future. Sensex will continue to repeat itself. But there is one single fact about the markets, that markets have always delivered in an upward direction in the long run. This graph is never going to invert itself in the long run. It has started its trajectory from downwards to upwards, and it will continue its trajectory in the upwards direction provided you are investing for the long run. So with this, we are going to close this session, and I'll open the round for all sorts of question and answer. I can see that some of you have already presented your question in the chat box. We still have 5 minutes to close questions. So Preeti, we can start answering the questions one by one.
Sure, ma'am. So there is a question from Ms. Shripriya Ramchandra. She had three questions. Very first question is PPF and triple E similar to PPF? And I suppose here with the triple E, she means to the schemes which have the invested amount tax-free, interest earned tax-free, and the maturity amount which receives tax-free. And so you answer. Do you want me to address all the three questions asked by the Shripriya, or you would like to take one by one?
So taking this question itself, EPF was triple E exempt like PPF before 2021. That is the principal, the interest, the employee's contribution, as well as the interest which is earned, all were entirely tax exempt prior to 2021. But in Feb 2021's budget, the government introduced a new law that any investment which is going from the employee's pocket above 2.5 lakh rupees in any EPF scheme, the interest which is generated on the investment above 2.5 lakh rupees will be now taxed at the tax bracket of the employer.
Okay. So, second question that Ms. Shripriya asked is, can we avail 80D deduction where we have opted for top-up, the medical insurance provided by the company, and premium for such top-up is paid by the employee?
Yes, if a premium is being paid by the employee, the deduction element can be utilized in your tax saving instruments under Section 80D.
Okay. And the last question that asked by Ms. Shripriya was ki, how do global factors influence this maths, the maths of sciences which Mr. Abhishek shared. So, for example, increasing in interest rate and dollar strengthening. So, how it will affect that maths calculation?
So, Abhishek, you presented markets at 52,000. Would you like to talk about the global factors impacting the performance of the markets?
Yeah, Shalini. So the question is if the global factors influence this maths, example, Fed increasing interest rates, dollar strengthening. So the maths that I shared, the global factors don't impact that maths. The calculation which we did, where we were trying to estimate where the markets would be. But in a short run, obviously the global factors will impact the markets with the Fed's increasing rates. So what happens when the Fed increases rates is there's an outflow from the Indian economy and from the developing markets back to US. So whenever liquidity is sucked out of the market, it generally leads to the markets correcting for a shorter run. So it impacts in a shorter run, but the maths that I presented, it does not impact that. Dollar strengthening, it can impact a little bit because I've taken a dollar conversion of about 80 in that maths. But apart from that, it doesn't impact anything else.
Thank you, sir. There's another question by Mr. Singh who wants to know what happened to the amount mentioned in EPS in EPF statement about the tax liability.
All right. So I assume here the investor is talking about the tax liability which is coming under EPF. So, if that is indeed the question, that I've already explained that initially, whatever investments were being made by the investor enjoyed a triple E status, exempt status. And in 2021's budget, we have recently got a reform that whatever investments are being made by the employee over and above 2.5 lakh rupees in the Employee Provident Fund scheme, the interest on such investments above 2.5 lakh rupees will be taxed at the tax bracket of the employee itself.
So there's another question by Mr. Ashwini Jain who wants to know if we go for additional BPF, will they be eligible for 8.5%?
Yes, any investment which is being made in the Provident Fund scheme is getting an interest rate of 8.5%. But earlier this was entirely tax exempt. Now any investment being made above 2.5 lakh rupees, the interest generated will carry taxation liability from this year onwards.
Okay. Next question is from Mr. Aditya Mangal. He would like you to provide more clarity on the new rule of EPF interest free up to 2.5 2.5 lakh per annum.
So Preeti, this is exactly what I've answered in the past two questions. I'll answer again once for the benefit of all of the audience. Okay. Initially, before 2021, all investments which were being made in Provident Fund, whether it was EPF or it was VPF, that is Voluntary Provident Fund Scheme, whether it was just the mandatory 12% contribution or over and above that, enjoyed a triple E status, exempt. That is no taxation on the contribution by the employer, by the employee, or on the interest earned. But now, as of February 2021, whatever investments are being made, the capping has been put at 2.5 lakh rupees. If there is an investment by the employee above 2.5 lakh rupees, the interest that any such excess investment earns will be taxed at the tax bracket of the employer.
Okay. And my next question is from Jain, Mr. Jain. He has in this information that Sukanya scheme deposits continue to earn interest after investments and stops at 14 years till maturity in 21st year. So can you give a little clarity on that?
Even though you have stopped investing after 14 years, your investments are still generating the declared return by the government, by the scheme.
Okay. And the next question is from Ms. Ruchita Shah. So this question you are already answered in this session, but it will be a more clarity for her. So she want to confirm that in under section 80D, whatever surplus deduction we are taking in under D is over and above 1.5 lakh deduction ATC.
Yes, Section 80C gives you a maximum tax reduction of 1.5 lakh rupees of income, and Section 80D gives you an additional capping of 25,000 rupees for yourself and 50,000 rupees for people who are above 60 years of age. So the maximum that you can take under Section 80D is 50,000 rupees if you or your parents are less than 60 years of age, and if both of you are above 60 years of age, then the maximum deduction over here becomes 1.
And there is one request from Ms. Neha Sehgal that she would like to know the source of the information which we presented in the Sensex section, the maths calculation, the data which we presented.
See, that's entirely logical extrapolation of figures, nothing else. So we talked about Sensex, which is currently at 52,000 level, and market capitalization to GDP at a current 100%, and the GDP at a $3 trillion. These are all facts. This is no source of information. This is all publicly available information. These are facts related to the economy. So all that we've done is extrapolated these into the future. That if market cap to GDP remains at 100% and the GDP which is touted to become $5 trillion in the next coming years happens, what will be the market capitalization? So this is a pure logical mathematical calculation, nothing else.
Okay, and there is one question from Mr. Deepen Gandhi. So he would like to know what should be the exit point in the market, how to estimate that.
So the exit point in the market should always be as per your goals. See, there are two types of investors which are there. One which are doing intraday trading and one which are doing investing. So if you are a trader, then invest, see if it has given a certain percentage of the profit that you wanted during the day and get out of that investment, get into another lucrative investment. If you are an investor like me, you should be investing with the perspective of your financial goals and risk appetite. So till the point your financial goals have not been met, till the point your decided tenure for the completion of those financial goals have not been met, stay invested in the market. Yes, it may be necessary to churn the investments as per the market conditions, but the exit point should not be till the time your decided goals have been completed.
So, ma'am, we have addressed all the questions that we have received in chat box. I would like to request the attendees if they have any other question that we can answer.
Sure. Thank you, Shalini. Thank you, Preeti. Thank you, Abhishek, for a great session. I hope the questions were answered well and the session was interesting to everybody. I mean, by the nature of the questions, I see obviously there's a lot of curiosity and a lot of knowledge needs to be shared and received. So thank you once again, Shalini, and thank you all the participants who took out time today. Let's connect 2 weeks from now for the third session, and meanwhile, please reach out to Shalini on a one-to-one basis in case you have any questions. I think she's already shared her details, or please reach out to me and I will connect you with Shalini straight away. Okay, so with that, I'm closing the call. Thanks once again, Shalini, and I'm also closing the recording. Okay, stopping the recording.
Sure.
Thank you so much.
Thank you so much, Mohit.
Such a wonderful moderator today.
This session. We'll be connecting in another 2 weeks on the topic of global investing. So stay tuned for that.
Yeah, we need to invest in Virgin Galactic and SpaceX, right, to earn some money. Yeah, happy to do that. All right. Thank you once again.
Thank you.
Thanks for your time.
Have a good day, everyone.
Yep, bye.